What's up everyone, it's Scotty with Money Investing. In this video, we are going to be talking about one stock, one company which reported earnings yesterday after the markets closed, is down a little bit over 17% pre-market as of the time of this recording. And I'm going to show you why it absolutely makes zero sense as to how low this stock can actually go. There's going to be an opportunity in this company eventually if this stock continues to sell off. And in the process, we're also going to learn a new concept. I'm going to basically go over a brand new process of really understanding stock valuations and company valuations. It's going to be a very, very deep value investing strategy, which was originally used by Benjamin Graham, the father of value investing, who also mentored Warren Buffett. But the reason why we haven't used this strategy on the channel, or why you haven't seen this strategy used by a lot of people, is because the markets have changed, right? So Benjamin Graham was using this back when there was the US Depression, the Great Depression, and prices were really suppressed and they were really low, and you were able to find companies that were trading far below their true values. But right now, we're obviously not in that environment. Market prices are way higher. Even on an average basis, they're much higher than this strategy basically shows you. So I'm going to go over that, and I'm going to use this company as an example because it makes perfect sense. So hope you guys enjoyed this video and find it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon is going to be down below if you're interested in joining, and of course getting access to all the buy and sell alerts, options alerts, trade ideas. There is going to be a 16% annual discount if you are interested in taking advantage of that. Link's going to be down below. So the company that we are going to be talking about today is going to be Twilio. And Twilio, ticker symbol TWLO, is down over 17% pre-market as of the time of this recording, as of the time of this video, trading at just over $46.37. The market cap for the company as of yesterday's close was about $10.35 billion. Now that is a really important piece of information to know about, because that's what we're going to try to assess for the company here. Because right now, since it's down about 17%, when the market opens, it's going to open somewhere around $8.5, $8.6 billion. Now keep that number in mind. $8.6 billion is where it's going to roughly open once the market opens here at 9:30 a.m. Eastern in New York, because it's down 17% pre-market. So that's the number we're looking at, $8.5, $8.6 billion, where it's going to roughly open at. Now, Twilio, as we already know, is a software as a service company that does provide cloud communication, a platform that enables developers to build, scale, and operate customer engagement within software applications. So it is a SaaS company based out of California. I've already done a couple of videos on them in the past, but this is just a little bit of an update. Now, the concept that we're going to be focusing on, which is the deep value investing strategy, is something called the NLV, or the Net Liquidation Value. I haven't talked about this on the channel before, but it is an important concept. And the reason for this is because, like I said, prices were trading way too high compared to their actual net liquidation value. So it never really crossed my mind, because none of the companies, none of the stocks really traded down to their net liquidation value. So it didn't really, make much sense. But when it comes to Twilio, we are getting very, very close. So that's exactly why the market is now starting to look very mental. In other words, it's starting to look very crazy as to how low the stock's going to come down to. So liquidation value basically is the net value of the company's actual physical assets, and if they were to go out of business and the assets were sold. So that's the value that we're trying to understand, is that, okay, if a company's assets, all their assets were basically liquidated, what's the value that we're going to get? And we're looking at net assets. We're not looking at just total assets, but we're looking at net assets, which is basically a combination of both your assets minus your liabilities. So we're not just accounting for assets alone, but we're also accounting for when all debts are paid off. Right? What is going to be that actual value? Which, Peter Lynch has also talked about this phenomenon as, you want to buy companies that have a very strong balance sheet, because if they were sold to another business, then obviously what is the price that you're getting, right? So Benjamin Graham uses this formula. Warren Buffett uses this in some way or another, looking at, very, very high earnings yield or low price earnings multiples. And then, of course, looking at high return on capital as well. But this is a formula which basically is the foundation. Like, this is at the minimum companies should be trading at least, because it's like saying that if the company has, $100, or let's just say that you have $100 in the bank, and that's being marketed, or market value of that $100 is $90. Like, it doesn't make sense. That $100 in the bank will always be $100 in the bank, right? You're just not going to be, imagine it's not going to be out of thin air, be worth $90, right? It's always going to be at least that much, that the worth that it has, it's going to be, that much. So that's where the net liquidation value comes in. And we're going to circle back to this because I'm going to calculate what Twilio's net liquidation value is going to be if we account for all assets and liabilities, and what the market cap today is going to be after the markets open, as we calculated earlier, close to 8.6 billion. So Twilio stock falls on weaker than expected revenue forecast. So EPS came in at 47 cents per share versus 21 cents. So beat on EPS. Revenue was also a beat at over $1 billion. And when it comes to the second quarter, companies expecting 27 to 31 cents per share on revenue of just under $1 billion, implying a 4 to 5% growth. Analysts were expecting 29 cents. So they came in within that guidance, and the revenue to be just over $1.05 billion, so a little bit shy of the guidance when it comes to revenue, but EPS was in line, and strong beats on both top and bottom line, and they are now turning the corner towards profitability. So that's another thing that we have to focus on, is that Twilio is another company focusing very much on profitability. Now, the CEO pretty much mentioned, Jeff Lawson, talks about how consumer-facing usage has been moderating, although Twilio is not losing market share, and Twilio is still seeking weakness in social, or still seeing weakness in social media, e-commerce, and cryptocurrency, and the customers are being conscious of their budgets and carefully examining their spending because of the larger economy. And at the same time, Twilio has been busy increasing the effectiveness of its salesperson, and it's not the business that the business has stalled. Twilio sold its verified authentication service to a very large AI company as well. So again, the numbers were good. I mean, you're seeing 15% growth on a year-over-year basis, over $1 billion. Organic revenue also growing, over 15%. We got data and applications revenue, 19% growth. Communications revenue was up 14%, and other revenue is up 26%. So you are seeing growth in all the metrics, all the segments of the revenue, and active customer accounts also up to over 300,000 plus, with the dollar-based net expansion rate at 106% right now, and non-GAAP income from operations at $104 million with 10% margins, and that's really where the focus is going to be towards profitability moving forward. And this right here is the entire guidance and the framework for the entire year 23. So we're expecting non-GAAP operating income of between $275 to $350 million. So again, if we do the math here, let's just do 8.6 billion. Let's just do 8,600 divided by 350. We're looking at the company trading at around 24.5 times operating income at the moment. And when it comes to sales, so 8.6 billion, and sales are expecting, they haven't mentioned the sales number, but I'm going to go with $4 billion just for the sake of this argument. We're looking at just a little bit over 2 times sales for the company at the moment. Now, financial framework, they're looking at 15 to 25% growth over the medium term, and data applications annual revenue of 30% plus growth for the company, and stock-based compensation as a percentage of revenue to be lower in 2023 than it was in 2022, reducing to 10 to 12% of the revenue for fiscal year 2027, and targeting GAAP profitability for fiscal year 2027. So they are profitable on a non-GAAP basis, but on a GAAP basis, they're targeting 2027 as a profitability. So quarter-over-quarter revenue growth as well. This is, I think, the first quarterly decline on a quarter-over-quarter basis, but year-over-year still growing, of course, but at a much slower pace. And that's what happens with the law of large numbers, right? Once the company is becoming incredibly large in terms of those numbers, the growth rate slows down, right? So it's not going to be 60%, 70% forever. It's obviously going to come down eventually. Okay, so now we come down to the valuation and the actual net liquidation value. Now, there's a couple different formulas that you can use for net liquidation value, because there's also something called a recovery rate, right? When the company has got accounts receivable on their balance sheet of about $500 million, what's going to be that recovery rate? How much can they recoup from their accounts receivable? Usually it's not 100%. There's going to be some losses. There's going to be some write-offs. But for the sake of this argument and this example, we're going to go with 100% for everything except for goodwill and intangible assets. We don't account for that because we don't know what the value is going to be, actual value for goodwill and other intangible assets. We're not going to account for that. So what we have over here are total assets for the company that are now worth $12.3 billion, and we are going to discredit goodwill. goodwill and intangible assets, right? These are not physical assets. These are not things that the company can actually sell. These are just like intangibles, right? Patents, IP, brand, whatever it is that they're valuing within their goodwill, intangible assets, we're going to discredit. And goodwill is a pretty big part of their balance sheet. It's over 5.2 billion. So rightly so, we're going to remove that out of the equation. So now we're sitting at, let's take a quick look at 12.298. The reason I'm laughing is because the market is just crazy with the valuation coming down so much, 5284 and minus 797 because that's another intangible asset. So we're looking at $6.2 billion. I just want to make sure that is indeed correct. So 12,298, we're just subtracting 5284, and then we're also subtracting 797. Yeah, so 6217 is going to be that number, right? That's going to be their total assets. Total assets excluding goodwill and intangible assets, but that's not their net liquidation value. Net liquidation value would be subtracting debts and liabilities from the number that we just calculated. So taking $6.2 billion and now subtracting their total liabilities. So in this example, total liabilities for this company, including long-term debt, all the finance lease liabilities, operating liabilities, accounts payable, we got deferred revenue, everything. We just take into account the whole liabilities and we just subtract it. They're sitting on less than $2 billion. So if you do the math now, we're looking at $6.2 billion of all physical assets that can be sold with 100% recovery, except for goodwill and intangibles. And we subtract 1980, we're now looking at $4.2 billion as their net liquidation value. Now we take this $4.2 billion, compare it with the actual market value, which at the beginning of this video we talked about after today's market open, it's going to be at 8.6 billion. So what does that mean? That means they are trading at 2 times their net liquidation value at the moment. So in other words, if Twilio today were to go bankrupt, they were literally just, sold off for their assets, we would get $25, $26 per share. And right now they're trading at 46. Now, most companies don't even come close to trading at 2 times their net liquidation value. PayPal's trading at, I think, 6 or 7 times their net liquidation value. Apple, Microsoft, Meta. We can go on and on. Nvidia, don't even get me started. Tesla, don't even get me started. They're trading way, way higher than their net liquidation value. But Twilio is coming way too close to pretty much trading at its net liquidation value. So for me, this is a no-brainer buy at close to $4 billion market cap, which obviously is going to be sitting a lot lower. But even at close to $40, which is going to be what? So another 17-18% drop. So from its yesterday's high, we're going to be looking at a 25% discount. So we're looking at $7.5 billion, where the net liquidation value is 4.2 with the path towards profitability. And of course, lots of cash with literally no debt, almost no debt. So we've got a negative net debt. Makes for a very, very low risk sort of trade-off, right? When you look at the potential that this company has and you're kind of assessing the risk, it's a very, very low trade-off, because from 7.5 billion to 4 billion, we're not looking at that much downside. 4.2, 7.5 to 4.2. We're not looking at that much downside because, again, net liquidation value is how much we can absolutely make if the company decides to, close out its business and of course pay off all its debts and liabilities, and literally all the assets are sold. And that's what we're going to get. The proceeds are going to be enough to pay off for that purchase. So that's where we are. For me, it's going to be a no-brainer, closer to 4 billion, of course, but the lower it gets, the less risk it carries now moving forward. And that's what's going to make Twilio very, very attractive at lower prices, because it's already down over 90% from its all-time highs. So let me know your thoughts down in the comment section below. What do you think, or what do you make about Twilio, of the future? And of course, this has been a violent sell-off here for the company. We have seen pretty strong moves, about 75-76% from this company, but this is definitely going to be quite an interesting stock here. I wouldn't even mind selling cash puts at $40, just depending on what the premiums are, but that's really what my assumption is going to be. So hope you guys enjoyed this video, find it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. Link to our Discord and Patreon is going to be down below if you're interested in joining, and of course getting access to all the binds alerts, options alerts, trade ideas. Everything's going to be included with the 16% annual discount. As always, happy investing. I'll see you all in the next video.